It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to Your Personal Bank Show. So I've got a lot of stuff to talk about today, of course, but, the last few weeks, we've really been talking a lot about what your personal bank is, how it works, that kind of thing. And if you did miss those previous shows, again, go to yourpersonalbank.com. You can listen to any of the previously recorded shows here on Money Radio, and you can get more information on, again, how your personal bank works. I'm going to touch on that a little bit, but what I really want to talk about today is those that should be looking at this, or those that should consider this, or why you should consider looking into your personal bank. I've been talking to a lot of folks lately, lots of clients and lots of new folks about this tool, about this financial concept, and how it can change and enhance their financial position. So really, I find there's 6 or 7 different types of folks that I run into quite commonly, that this typically is quite a benefit or enhances their financial situation. And what are those situations? Well, it's really quite simple. I'll run through them really quick here, and then we'll spend a little time talking about each one of those a little further. So again, if you don't have time to listen to the whole show today, go to yourpersonalbank.com and you'll get more information on it. And of course, contact us if you want more information. But really, the types of folks that I run into that this makes sense are probably the first probably and the most common I run into, especially from Money Radio listeners, obviously, is diversification. And not only, most investors understand diversification and the benefits. It's kind of hard to argue otherwise, mitigating risk, spreading risk over a number of different investments. Most people talk about, sectors and different classes and things like that. But really what I'm talking about here is diversification into a non-correlated asset. Now, what is that? What is diversification in a non-correlated asset? Well, it's really quite simple. A non-correlated asset is an asset that basically has nothing to do with, in terms of its returns or its value, to another asset. So, this is Money Radio. A lot of folks are invested in the markets, that kind of thing, Wall Street and that type of thing. A non-correlated asset is an asset that would basically not correlate or not have anything to do with the Wall Street or the Wall Street type of investments. This, we have different types of your personal bank tools, the insurance products that we use to maximize cash growth. Some are based on the indexes and like S&P 500, so that would be correlated. But we have some that are what I call the consistent steady. They're guaranteed, they grow every year, and it's non-correlated to what the economy's doing, the stock markets, anything. It's consistent, it's steady. We have accounts, like I said, that are currently paying over 6%, have every year for the last 25 years in a row. And some of these companies have paid these dividends 6% plus, or never missed a dividend, I should say, since before the Civil War. Okay, so these are very, very long-term dividend-paying type of accounts over a very long period of time. Okay, A+ rated, plenty of cash reserves. These are the granddaddies, if you will, of dividend payers, long-term dividend payers. By putting some assets or putting some funds or allocating some funds in that direction, what you're doing is you're diversifying truly into a non-correlated asset. Something that's going to grow with some consistency, okay? So that makes a lot of sense to a lot of clients. We can talk about that a little further if you want. But the next one I'd like to run into quite often is someone who's looking to increase returns. Now, that might seem to a lot of folks who are familiar with, again, a lot of my Money Radio listeners, that might seem counterintuitive. How can a life insurance contract increase returns? Well, in and of itself, it doesn't. But remember, what is your personal bank concept? What does it do? It's a combination of two financial tools, a banking tool and an insurance tool. Remember, we're using a high cash value insurance contract to maximize cash growth. And then we're accessing the funds from a bank line of credit, and the collateral for the line is the cash in the policy. You see, this works very similar process to a HELOC or a home equity line of credit. The principle is basically the same. A HELOC, most people are familiar with, is a line of credit that you can get typically against a primary residence if you have equity in your home. Now, in most cases, those types of loans or the lines of credit don't include any fees, loan fees, costs, or anything like that to set up. These don't either. And you only get charged interest when you actually access or use the funds. See, HELOCs are a tool, a financial tool, that's used quite often with business owners, particularly real estate investors, but even just average individuals. It's quite often that I will encourage somebody to set up a HELOC if they have equity in their home. And why? The reasons are quite simple. It's an emergency fund that could be used if needed. And particularly with COVID and the economic volatility, let's put it that way, and uncertainties that we've faced recently, having access to funds is more, and you don't need it, is more important or better than all of a sudden find yourself in a sudden situation economically or personal situation comes up, health issues, business losses, income losses, things happen. I mean, that's life, right? Having that reserve, that emergency reserve, we always talk about people talk about having 3 to 6, sometimes 12 months of cash reserves available for emergencies. Well, a HELOC can be part of that tool, a part of that plan, by the way. Well, these work, again, under the same principle. The cash in the policy is the equity or the asset, okay? The line of credit, the bank line of credit, of course, is the tool that's used to access the funds. Here's where it gets interesting to where you can actually use this tool, this concept, to increase returns on whatever your investment is. It's simple. With a 6% crediting, like they're currently paying now and have for the past 25 years in a row, and longer, by the way, you can grow. The money is going to get credited and grow at 6. There's lines of credit. There's some amounts, minimum amounts. It's $60,000, by the way, 65 actually. But you can access the funds at 3%. So one of my points I make to folks all the time is I was talking to a bank branch manager, mortgage expert, literally a day or two ago. And I said to him real simply, look, if the money's growing at 6 in this policy and you access it and you're getting charged 3, what's your money doing? And the answer is pretty obvious. Well, it's growing. You're making a 3% positive arbitrage. Why is this so important? Well, it's quite simple. The use of those dollars can be used for any purpose. There's no tax consequences also. So we have a lot of business owners that use this tool to supplement or expand business, things like that. I have a large number of real estate investors that do the same thing with their real estate investment businesses. An individual can invest. I have a number of folks that do that where they invest in various investments, portfolios, assets. It doesn't really matter. I have cryptocurrency investors, precious metals investors that use this tool to enhance their returns. Again, I say this to folks all the time. Look, if you have an investment you like and it's working for you, keep doing it. I'm not here to tell you to stop doing that, or what I'm going to tell you to do is let's enhance it. So if you have something that's working, keep doing it, of course. But what if you could enhance it? Instead of taking dollars and investing directly into that investment tool or that asset, whatever that is, why not put it into the personal bank? We can have up to 90% liquidity, by the way, day one on these kind of things. 60 to 90% is the range, just so you know, depending on the situation. But if we're doing a lump sum, for example, we can have up to 90% available. Day one, take those dollars, have them grow at 6, access them through the bank line, get charged 3, you're picking up 3% positive arbitrage. What do you do with those dollars? Put them into that investment. And as I say, if your return is 7%, how would you like it to be 10? If your ROI is 10, how about 13? We're going to talk about this further and the other reasons and other types of folks that should look into this. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. Today we're talking about the type of folks or the situations that folks should look into for folks that should look at your personal bank, I should say. Like I said, in the last few weeks, we've been talking a lot about how it works. Let's talk about who should look at it. What situations would this be enhance your financial situation? And the first one I already talked about is diversification in the first segment. Not diversifying into a non-correlated asset. Again, a non-correlated asset is an asset that has nothing to do in terms of returns or value to another asset. So, for example, if your portfolio is primarily in the markets, okay, then you want to diversify into a non-correlated asset. You need to have invest into something that has nothing to do with the market, nothing to do with Wall Street. We have fixed, steady, eddy, consistent options that satisfy that goal, and you can diversify your portfolio, okay, safely with guarantees with tax benefits. Okay, the second reason is increasing returns, and like I said, on first glance, a lot of people look at that, and it's like it doesn't compute. It doesn't. What do you mean? How can I increase returns in a life insurance policy? Well, it's simple. In and of itself, that's true, but we're using the personal bank concept. Remember, we're using an insurance tool and a banking tool. We're growing monies in a high cash value policy, currently paying 6% plus, has every year for the last 25 years in a row, never missed dividends since before the Civil War, okay? Long-term dividend payers. And then we're accessing those funds through a bank line of credit. The collateral for the line, of course, is the cash in the policy. The policies are crediting 6% right now and have for a long time, 25 plus years, and you can access it at 3% through the bank line of credit. There are variable and fixed line of credit options, by the way, so I asked that question all the time. But the thing is, you can create a positive arbitrage. Currently, you can create 3% positive arbitrage. So therefore, you can invest in whatever asset or investment you're doing, whatever it is you like. Keep doing it. If it works, keep doing it. I don't care what that investment is. But why not add 3 points or 3% to your returns? If your average rate of return is 7%, you can add 3% to that by flowing it through the personal bank. You can access most of the funds. Like I said, 60 to 90% is available. Day one, when we do lump sums, we often get at 90% plus, okay? So my point is simple. Most of your money, you could take it and invest it in your investment and make 7, for example, ROI, rate of return on investment. Or you can flow it through the personal bank and add 3% on that. And basically your return now is 10. So my question all the time is, what's your rate of return? Somebody will tell me. What's your average rate of return? Great. How'd you like to add 3% to that? If 7 is your number and you add 3, you've nearly added another almost 50% more return. That's huge. If your rate of return is 10%, for example, that's a pretty good one these days. I think most people would agree. You add 3%, 30% increase of your rate of return. Those are huge percentage increases. In fact, last week I was talking to a business consultant. He consults businesses, a very successful consultant, and as he said in his industry, I asked him what's a good rate of return for the typical business that you're consulting, and he said 10% is a good number. Most companies are happy with that. Top line profit. I said, and by the way, businesses use this tool, the personal bank tool, quite often. I said, what if you brought this to the table and then showed them how to increase their returns by another 3%? He goes, he said it to me before I did. That's huge. 30% increase of ROI, top line profit. I said, exactly. That's how your personal bank tool can increase your rate of return and keep doing what you're doing. See, I'm not the enemy, as a lot of people think. Or, unfortunately, it's human nature. A lot of folks out there are like, well, you don't want to talk to this guy because it's human nature for any advisor. And I'm not picking on anybody, but it is. It's human nature. You don't want them. You want them listening to you. Okay. So if you have a good relationship with your advisor, they're going to be motivated to keep that relationship, obviously, and be disinclined to bringing in something else that might seem to infringe on that. Right. I'm not the enemy. In fact, I'm going to encourage, if it's a good situation and you're doing well and you're comfortable with it and it fits your plan, great. All I'm going to do is show you how to enhance it. Okay? And that's what a lot of advisors just don't realize. But hopefully some folks, obviously a number of folks do because I've been talking to them. So contact me, yourpersonalbank.com. I'll show you what I'm talking about, and I'll show you how to increase the returns on your investments, okay, whatever those may be. So we talked about diversification. We talked about increasing returns. By the way, we can also increase liquidity. Now, again, on the surface, that seems counterintuitive. What do you mean? Well, actually, it's quite simple. As I stated, we're setting up these insurance contracts to maximize cash growth, not death benefit. There is a death benefit, understand, but that's secondary in most cases that I deal with. By the way, there's a living benefit. It takes care of chronic, critical, terminal illness situations. That's all built in. No additional charge. That's kind of nice to know. Those things are there. So sometimes, I guess that's another one of the reasons I jumped ahead a bit. But the thing is, when we build the cash, as I told you, we're maximizing cash value. Again, think of a teeter-totter. Put cash on one side, death benefit on the other. Most insurance contracts are structured where they're limited, minimal, or even no cash, right? Term has no cash. And they're maximizing death benefit. The purpose of that tool is to maximize death benefit protection. Notice most people, when they're looking into insurance, are like, how little can I pay to get the biggest death benefit? And that's how most contracts are set up. And their purpose is to protect for that death benefit needs that are there. And you should have those. I have them myself for my family, for my business. But it's not what I'm talking about here with the personal bank concept. This is the opposite. In the teeter-totter, you put the cash on one side, you lift the cash as much as possible and minimize the death benefit as much as possible. So the teeter-totter literally looks the opposite of what's typical. Notice everything they were familiar with. Insurance, I tell people all the time, you're going to throw it out the window, flip it on a dime. It's completely the opposite. We're maximizing cash. As I stated, most cases, we're looking at, I'll say conservatively, 50% liquidity day one, over 90% liquidity day one, depending on how we structure it and how it's funded. The thing is, if you're looking to fund it to increase liquidity or increase returns, usually people put lump sums in. They'll reallocate some dollars and put it in here. But here's the thing. The funds are available, majority of the funds are available through the bank line of credit and a positive arbitrage situation, as I've stated earlier. So you have use and access to those dollars without losing gains on the investment, on the funds. One of the things I say to people all the time is put your money in here, and it's going to, right now it's paying 6% plus. Leave it there, you're going to get credited 6%. Access it through the bank line of credit, which is charging 3%. You're picking up 3% positive arbitrage. So leave it there, make 6%. Access it and use it for other purposes, still make 3% on it. See, that's huge. One of the statements I make to folks all the time is, how would you like to earn interest on dollars you spend? Which leads me to the next reason. That's basically to reduce finance or borrowing costs. Okay? So what does that mean? Well, if let's say you're purchasing a car or any big ticket item for that matter. Really, we have two options. We can either pay cash or we can finance it, right? I mean, that's basically what it comes down to. So if we pay cash, by the way, what happens to those? Let's say we pay $50,000 for a vehicle. The $50,000 you just gave to the car dealer or whoever you bought the car from, those monies, will they ever earn interest in the future for you? Will you ever gain anything from those dollars? I mean, you own a vehicle now, but those dollars are gone, aren't they? The ability to earn interest on them or any gains on them is completely gone the rest of your life. So I tell people who are looking at paying cash for large ticket items, for example, you can pay cash, of course, and you own the vehicle, only whatever that item is, or you can fund it into the personal bank, access the funds earn 6%, access the funds through the bank line of credit, get charged 3%, and purchase that item, purchase the car. But pick up 3% on that money for the rest of your life. You're earning some positive arbitrage, interest on that the rest of your life. The difference in the amount of monies is significant. Stay tuned. We're going to talk about more and the other reasons why people should look into your personal bank.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking a lot about the reasons why folks should look into your personal bank, or the situations that enhance your financial future. We've talked about diversification. Diversify your portfolio into a non-correlated asset. Again, that's an asset that's not has nothing to do with the asset that other assets in terms of returns or value. So you're truly diversifying. You're putting things in different buckets, if you will. Personal bank can satisfy that need. You can increase returns. How? It's quite simple. You put the funds into a personal policy, high cash value policy. Right now, paying 6%, have over 25 years plus. You can access through a bank line of credit at 3%. You're picking up 3% positive arbitrage. What can you do with those dollars? Reinvest them into an asset or investments that you like and add 3% to your returns. Increase your rate of return by 3%. That's significant. That's huge in many cases. You can increase liquidity. Like most investments, you when you put them into it, if you access it, you stop gaining a return, right? You stop earning. Here, I tell people all the time, you put it in the personal bank, you can earn 6%. If you access it and use it for other purposes, you're still picking up 3% on the money. So you have access to your money to do things, pay bills, purchase items, invest in things, and still pick up 3%. So your money's still working for you, still going forward. So that's powerful. Which leads me into the reducing the cost of financing or purchasing or paying cash. When you pay cash for items, like big ticket items, of course, when you pay cash, you give up the ability of those dollars to earn interest or gains for you in the future. If you flow it through the personal bank, you can pick up that 3% positive arbitrage. You can buy that car, pay cash for that car, but you earn 3% on that money at the same time. And you can earn interest or positive arbitrage on that money for the rest of your life. That can be a lot of money, depending on how many years we're talking about. Also, financing. Let's say you are going to finance a vehicle or a big ticket item. How would you like to reduce the interest cost on that by 3%? I have an example last week I did with a couple who just refinanced their home, and the interest rate, 30-year fixed, was 3.25. Okay, which those are available these days. They had an account with some funds they weren't overly satisfied with. They weren't happy with, frankly. Had some risks that they weren't willing to take, and returns weren't where they wanted them to be. So they put them into a personal bank account. They're earning 6.1, by the way, in this situation. They're going to access the funds through the bank line of credit at 3%. So those are picking up 3.1% positive arbitrage on those dollars. They're going to take those dollars, this is their plan, and pay the mortgage payments. Their mortgage, I told you earlier, was 3.25%. I shared this situation, by the way, with a mortgage broker a couple days ago. He loves it. He's like, this is brilliant. If your mortgage interest is 3.25% and your positive arbitrage is 3.1%, what's your net result, the cost of your mortgage or interest in that situation for this couple? Well, it's 0.15%. That's their net effective rate of their interest rate on their mortgage. You could apply that to any type of debt or financing. Take the interest rate, whatever that may be, reduce it by 3%. That's what your personal bank can do. By the way, on a 30-year fixed mortgage, do you have any idea how much? We're talking over 100,000, well over 100,000 in interest savings for this couple over this 30-year period. It's closer to $250,000, actually. My point is, hundreds of thousands of dollars of interest is being saved by utilizing your personal bank tool. Now, they were going to make the mortgage payments anyway, weren't they? All they're doing is putting a slightly bit more in the personal bank, earning the 6%, accessing it at 3%, and using those dollars to pay the mortgage, and saving themselves hundreds of thousands of dollars of interest over the lifetime of the loan. This is a powerful, powerful tool for reducing interest on debts or financing, okay? The other reason is reducing taxes, overall tax liability. We run into this quite often, particularly with business owners, higher income earners, folks like that. I deal with this on a regular basis. You see, the thing is, there's a lot of financial tools out there for the income earner. There's qualified plans and all these types of things that are out there. The thing is, though, for the person who's a high income earner, for example, and they're putting monies, they're earning monies, they're putting monies away into qualified plans, IRAs, 401ks, pension plans, all types of different qualified programs out there. And those are great for reducing immediate and current income tax liability. This problem is when you look at it in a lot of situations, and I'm going to say this right off the bat. This isn't for everyone, but it's certainly worth looking into and considering. I have a meeting next week with another gentleman where we're looking at the numbers both ways. But his concern is he's fairly young, and if he puts away a bunch of this money into these qualified plans, and by the way, he's funding all of these things, 401k, SEP IRA, pension program, all of it. But his concern is down the road, what's the tax liability going to be when I access those funds? And see, that's an answer nobody has, because that requires knowing what the tax rates and the tax situation is going to be in the future. In this case, decades from now. Obviously, that's an uncertainty, and he's uncomfortable with that uncertainty. As it stands in most cases, most of these funds that he's putting into these qualified plans already have market risk. And I'm not saying market risk is necessarily a bad thing. It needs to be mitigated. But he understands he has the market risk. But then he also realizes he also has a tax risk, a future tax risk. What's the tax rate going to be in the future? And there's a really popular book called The Power of Zero. It's written by David McKnight. The foreword was done by Ed Slott. He's considered the premier. He's a CPA. I had a show on him, some things he did. I was recommending a month or two ago. Go to yourpersonalbank.com and you can check out the Ed Slott discussion I had, things that he recommended. He's considered the premier qualified plan CPA in the country by the Wall Street Journal. And Ed Slott wrote a foreword in this book called The Power of Zero. Highly recommend it if you've got a taxable situation. The main thing, and Ed in there, he firmly believes taxes in the future will be higher. I'm not going to say they're going to be higher. I'm going to say we don't know. And I think that's the facts. We have extraordinary debt, federal debt levels, all types of things going on. It looks like it's only going to get higher with more COVID-related stuff that the feds are doing. The point is, what are tax rates going to be in the future? We don't know. And the premise of the whole book is real simple. If you have a tool, an asset, where the tax rate on it is zero, the income tax is zero, if the tax rate's double, 2 times 0 is still 0. So having a bucket of funds, I'm not saying all of it, but having an alternative, in other words, pouring everything into qualified plans to defer the tax today, may or may not be the best plan. It's all going to depend on what the tax rates are in the future, isn't it? Which is an unknown. By diversifying, putting some of those into a bucket where the tax rates in the future doesn't matter, in other words, 2 times 0 is still 0, it gives you options, and he can then choose which bucket, more or less, he'll have options in choosing which bucket to access or how much to access from each bucket to mitigate his future tax liability. A lot of business owners, a lot of high-income earners, professionals, things like that, once explained and shared that, get it immediately. Makes sense. So if you're looking at a situation where you're deferring a lot of your taxes today, you're kicking the can down the road, essentially, right, into an unknown future, and you want to mitigate some of that risk, that tax risk, your personal bank can solve that, can create that bucket for you, okay? So that's why reducing taxes, and that's one example. Another one is where folks have high tax liabilities in qualified plans and various things. There are options, there are ways, depending on the situation, to mitigate that. And sometimes we involve using like charitable trusts and different things like that. But there can be some legitimate legal tax mitigation strategies. And many of them involve insurance policies. Your personal bank's a great tool for that, okay, where we can mitigate current or shorter-term tax liability. So contact us at yourpersonalbank.com. We can discuss that and share with your situation and show you how we can help out on that. Well, stay tuned. I got 1 or 2 more reasons why folks should look into, or situations when people should look into your personal bank.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, welcome back. We're rounding third. We've been talking a lot about the reasons why, or the situations why folks should look into your personal bank, where it would be enhance your financial situation. There's really 7, and I've gone through the first 5. I'm going to hit the last 2 in the last segment here. If you missed the previous reasons why, recommend go to yourpersonalbank.com to hear the whole thing. But anyway, the bottom line is diversification into non-correlated assets. True diversification, where you're investing, your portfolio has non-correlated returns and responses depending on economic situations, being outside the Wall Street bubble, if you will. Increasing your returns. We can add through the positive arbitrage of the high cash value policy with the bank line of credit. We can add currently a 3% positive arbitrage. And again, long-term historical positive arbitrage scenarios to the returns. So I say to folks all the time, if you're making a 7% ROI, rate of return on investment, how'd you like it to be 10? We can do that through Your Personal Bank tool or the concepts. Anyway, increasing liquidity. Again, using the high cash value policy with the bank line of credit, you're going to have access to somewhere upwards of 90% cash available day one. You can access those funds. If you leave them where they're at, they're growing at 6. They're getting credited at 6. If you access them through the bank line, they're still growing at 3, the positive arbitrage. So you can use your dollars for other purposes like paying expenses, supplementing retirement, purchasing items, paying debt, whatever that may be, and still pick up some return on your money. Okay? So your money goes farther. It lasts longer. That's the point. So you don't run out of money in retirement, for example. You can reduce finance or borrowing costs. This is pretty simple. Again, that 3% positive arbitrage gives you a situation where if you're financing something, borrowing that, you have an interest rate, whether that's a mortgage, car loan, student loan, business loan, any other type of loans where you have an interest rate, you can reduce that by 3%. That's huge. In many cases these days, with interest rates the way they are, it's pretty much eliminating the interest on debt, okay? You can reduce taxes. Again, if you're growing monies into a tax-deferred policy, which all of these are, the funds grow tax-deferred in the policies. Some of them you can access tax-free. Some of them you can access directly from the policy are taxable. But if you access the funds from the bank line of credit, there's no distribution. There's no withdrawal. There's no policy loan. Therefore, there's no 1099 issued by the insurance company. Therefore, no taxable event occurs. You're accessing the funds through the bank line of credit. And by the way, another tax advantage here is if the funds are used for business purposes, often the interest on the bank line of credit is now a tax deduction. So I have a lot of business owners that are perfectly legally growing money tax deferred. So the money's growing in essence tax-free for them, right? They're accessing it from the bank line of credit, and they're getting a deduction on their interest. So they're growing tax-free, accessing the money, and getting deductions on the interest on that, okay? Pretty powerful, very powerful tool, plus the positive arbitrage, okay? The other one is living benefits, medical expenses, long-term care, those kinds of things. Built into these contracts, there's been some tremendous, if you have an older policy, I'm going to tell you, I'm going to say over 3-4 years old, you need to look at updating it, okay? Because these weren't available. These living benefits are now pretty much available across the board, where if you need you're in a situation medically where you have a critical or chronic illness, need long-term care or terminal, the funds, the death benefit, again, we're not using as primary as death benefit. We're maximizing cash, but there is a death benefit there. You can access, typically in most cases, a good percentage of the death benefit for medical expenses, chronic, critical, long-term care, whatever that may be, or even terminal. Why is this so important? Well, gosh, long-term care expenses and medical expenses for are very expensive and keep going up, don't they? And so this is the best. I always say this is, in my opinion, the best long-term care or medical expense situation you can have, because if you need it, you've got it. If you don't, you didn't pay for it. So really, what could be better than that? I've had folks that have been able to eliminate their long-term care expenses, having like long-term care insurance that they're paying and stuff, and reallocate those dollars, which, by the way, long-term care insurance typically costs go up over time, don't they? The premiums, the contributions. They've been able to eliminate that and still have that similar type of protection or coverage or, access to funds if they need it. So it's not a long-term care policy. I don't want anybody to misunderstand me on that. It's a reimbursement. So in other words, the funds are there if you qualify. Usually it's standardized 2 out of 6 activities of daily living which is the same language in a typical long-term care policy, by the way. But if a medical situation, critical, chronic, terminal, long-term care scenario comes up, you have access to dollars, tax-free, from an advance on the death benefit, significant amounts of dollars. Most of my clients have, 3, 4, 5, 600 or more, 100,000 available in many cases. Okay, so I have a lot of medical folks, doctors, and different people like that who are clients and become clients for the personal bank, primarily because of the living benefits, the medical benefits that are there, because they see it firsthand. They're on the front line, right? And then the last one is a family legacy. If you're looking to pass on assets to the next generation, it's hard to argue, and almost anyone would agree with this, it's hard to argue that life insurance is not the best and most efficient tool to pass on assets to the next generation. Insurance does have some unique benefits tax-wise in passing on, particularly to the next generation. I've heard terms with qualified plans and things like that. I've heard things as like tax hostile, and they are. If you have large IRA accounts or qualified accounts, and you're looking to pass those on, the Ed Slott I mentioned earlier, he's considered the premier qualified plan CPA by the Wall Street Journal in the country. I've heard Ed speak several times. He knows what he's doing. He's stated that life insurance are the new stretch IRAs. The stretch IRA rules have changed. They basically no longer exist since the 2018 tax law change. Insurance is the tool that's used to pass on assets in a tax-favored basis to the next generation. So if you're building a personal bank tool here, you have access to funds. Your cash grows. You have access to funds while you're living and you can access them through a tax-free basis by using the bank line of credit, pick up a positive arbitrage. And then ultimately, all of this gets passed on to the next generation through the income tax-free death benefit. There are certain limitations, and then there's other tools we can use if you get above those limits. There's irrevocable life insurance trusts and various other, the ABCs of estate planning. We have attorneys we can connect you with that can help you get that all done, very reasonable, with a very reasonable cost. But my point is, if you're looking at legacy, family legacy, next generation, things like that, it's hard to beat this versus any other financial tool out there. It just is. So there you go. There's the 7 reasons that the 7 situations: diversification, increase returns, increase liquidity, reduce borrowing costs, reduce your taxes, take care of medical long-term care type of expenses, and to maximize a family legacy. If you're in any of those scenarios, contact us at yourpersonalbank.com. You want more information, be happy to talk to you about it and share how it can enhance you, your family, and your business financial future.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.